So every time we would have a recession, they cut rates. They encourage more credit growth to keep happening, both on the private side and then the public side. And then when it kind of fully, when you hit zero rates and there's really not much more to do, the private side finally starts to blow up. That's what we saw in 2008. So most metrics were like, debt compared to base money, for example, or all those types of metrics were extremely out of line based on historical norms. And so then they turned to money printing. They radically increased the monetary base, and they kind of indirectly pivot some of that private debt toward the public sector. So they bail out the banks. When the next recession comes and we get the lockdowns, and then you kind of bail out individuals, bail out small businesses, bail out big businesses. Again, you kind of rotated some of that private debt to the public debt. And really, when they kind of get it this far, there's not many more places to kick the can. The can's now kind of firmly with the currency. That's where the can gets kicked. It gets kicked into currency devaluation, financial repression.
With US debt now towering at 125% of GDP and inflation still stubbornly above target, our economy is drifting into dangerous, uncharted waters. According to Lyn Alden, we're on the verge of financial repression and a looming currency crisis, situations that haven't been seen in modern history. As interest rates lose their punch and deficits spiral out of control, the Fed might have no choice but to resort to currency devaluation, triggering a potential economic tailspin. Alden warns that the Federal Reserve could soon be forced into expanding its balance sheet just to keep the system afloat, a move that could severely weaken the dollar and erode your savings. This isn't just theory, it's the financial reality we may soon face.
The Fed has a long runway for where their interest payments would become a problem. There are some countries where the way the rules work is that the government has to compensate the central bank for running losses, which makes for really bad headlines, really bad optics. It's like, hey, we did all this QE, we literally somehow lost money from printing money, and we need taxpayers to fill that gap. That's a terrible headline. The way it works in the United States is they just defer the losses until literally years down the line when they return to profitability, they just pay that back. They kind of dig themselves out of the hole. It's basically a bank that can go into negative equity and no one can do a bank run on it because the deposits are banks. And they're kind of locked into that monopoly. So they don't really have any sort of immediate need to cut. Now, you could argue that the United States, however, needs lower interest rates, that basically that the central bank looks at the fiscal deficit side and wants to be accommodative. That's certainly a possibility. That's generally what happens when you get well over 100% debt to GDP. You usually get some degree of financial repression, either subtly or overtly. So that's certainly a factor. And then there's just the fact that high rates are less effective when the government is so indebted for reasons I outlined, which is that when fiscal deficits are bigger than the amount of bank lending that happens in a given year, or even bigger than the sum of new bank loans and new corporate bond issuance, rate hikes become less effective at slowing things down because you're exacerbating the deficits pouring money into the economy. And then the final factor is that when you could back up a second and say, should the central bank even set interest rates? I would argue no. Like, I don't really agree with the philosophy of central banks setting the price of money because in every other context, price controls are bad. And I don't see why money would be different. I think there's a lot of evidence showing that it's bad. But in the current laws for how they operate, they have this kind of mandate between inflation and unemployment. And when they see the official way that they measure inflation falling down to around 3%, which is still above their target, but it's not extremely above their target like it was before. And then they see unemployment go from 3.4 to 4.3%, which is already at the high end of their projections for what they thought it would look like by the end of next year. Like, so it already kind of reached their quote unquote target or where they expect it to be. They certainly can. I can see why now they're balancing between these two mandates. They spent a while kind of only during the lockdowns and everything, they were fully focused on the unemployment side. They didn't care about inflation. And then when inflation took off, they were late to respond to it. But when they responded to it, they kind of were like just fully on the inflation camp. And now they're kind of back toward balancing both of those mandates. So I think that gradual cuts make some sense if you're following that algorithm of trying to balance those two numbers, which again, philosophically, you could say it's not even a good mandate to be following, but that's the mandate they have in front of them. Fiscal dominance has a couple different ways of defining it, but yeah, it's basically when the fiscal side is so much more impactful than the monetary side, and then can even constrain the monetary authority from doing what they want to do. And it could take a couple different forms. It could be like what's happening now, which is that they make rate hikes less effective, because if you when Volcker raised rates, 40 plus years ago, he did it in the context where public debt to GDP was like 30%. And the money supply growth is mostly coming from the highest ever level of bank lending. And that was because
Okay.
baby boomers were entering their home buying years. So peak credit formation, plus of course you have all the issues around oil shortages going off the gold peg, all the supply side issues. But the demand side was like, where was money coming from? It was mainly coming from bank lending. And so when he raised rates, he slowed down the bank lending, and he did blow out the deficit too, but he blew it out from 30% of GDP. So the downward pressure his rate hikes put on the bank lending was greater than the upward pressure it put on deficits. Whereas when you're in Powell's situation and you're raising rates against like 125% debt to GDP, he did slow down bank lending, but bank lending was already kind of moderate. That wasn't the source of
Mm.
excess money creation. So he slowed down something that was already moderate, but then he completely blew out the deficit by, ironically, an even larger number than the bank lending. And so we're kind of stuck with inflation, years after the kind of the core stimulus and the lockdowns and all that. We're still at above target inflation because some of it's sticky. Um, and it just becomes less effective. And then if you look at the New York Fed's annual report, they project that by the end of 2025, they're probably going to go back to balance sheet increases. And that's not necessarily to be stimulative on purpose, but it's to maintain what they would consider ample bank reserves in line with nominal GDP. So like it would kind of go up at the same rate as GDP if they're not trying to be stimulative or restrictive. But that basically means they intend to go back to structural deficit monetization. And so basically, a central bank can lose control of its balance sheet size if the government's just pouring out too many bonds. And one of their kind of shadow mandates is financial stability. So if the treasury market ever goes illiquid, they kind of have to step in. That's what we saw when the UK gilt market blew up in 2022.
Hmm.
And I think we'll see more of that happen in various developed countries where a central bank might have to do QE even when inflation's above target. And then you get kind of like emerging market like characteristics, at least around the margins. Well, so there's a challenge with sample size. So that was like one big, 80-year cycle. If you look at the prior 80 years, there wasn't that big cycle
Mm.
because that was a whole different monetary environment. That was like more of a gold standard. Even some of that 80-year period would have been free banking. So that was a different environment. So it's kind of like this one snapshot in time. Even, there's like data sets that go back like thousands of years and look at like, interest rates throughout, like, say, Europe going back, and like Mesopotamia going back very long time. The interest rates that we got to in the middle of the 20th century were like the highest ever. And that's also because this is the only time where the entire world was on fiat currency. This kind of 50 plus year period is actually kind of unusual
Mm.
in monetary history. So I think it's kind of difficult to project it going forward. The way that I would kind of frame it is that, in the 1970s they defaulted on the gold redemption, and but they still had a lot of capital built up, especially after Volcker raised rates so much. And they've kind of spent 40 years drawing down from that like really powerful starting point. Um, and the way that they got out of every recession was keep inflating it, keep reinflating it. So every time we would have a recession, they cut rates. They encourage more credit growth to keep happening, both on the private side and then the public side. And then when it kind of fully, when you hit zero rates and there's really not much more to do, the private side finally starts to blow up. That's what we saw in 2008. So most metrics were like, debt compared to base money, for example, or all those types of metrics were extremely out of line based on historical norms. And so then they turned to money printing. They radically increased the monetary base, and they kind of indirectly pivot some of that private debt toward the public sector. So they bail out the banks. Then when the next recession comes and we get the lockdowns, and then you kind of bail out individuals, bail out small businesses, bail out big businesses. Again, you kind of rotated some of that private debt to the public debt. And really, when they kind of get it this far, there's not many more places to kick the can. The can's now kind of firmly with the currency. That's where the can gets kicked. It gets kicked into currency devaluation,
Mm.
financial repression. Um, and so, my base case would be interest rates are kind of choppy and sideways for a while. I wouldn't be surprised if we just ping pong between 2 and 6% or somewhere in there. Obviously, it's going to depend on what happens, but there's a certain point where if you have very high public debt and you have inflation coming from fiscal deficits, raising rates stops being effective because you literally just increase the deficits even more.
Mm-hmm.
Um, and so it just kind of it risks becoming a tailspin. So I think that the future in general just looks very different because we've never really gotten to a place where fiat currency, kind of exhausted a lot of its options. And the whole world's on this fiat standard. This is kind of a new situation. So I wouldn't sit there and say, well, look, okay, it took 40 years of rising rates and 40 years of falling rates, and we're going to get 40 years of rising rates. I don't think there's a pattern that close, other than to say that clearly the 40-year pattern of falling rates is behind us now.
Thanks for tuning in today. We covered some critical points from Lyn Alden's insights on the current state of the US economy. As we discussed, with US debt at 125% of GDP, inflation still above target, and interest rates losing their effectiveness, we could be heading towards a period of financial repression and a potential currency crisis. The Fed might soon be forced into actions that could have long-lasting effects on the dollar and your financial security. If you found this information valuable, make sure to hit that subscribe button and give this video a thumbs up. And don't forget to share your thoughts in the comments below.